All right, I'm not one to like give conspiracy theories, but this whole QYLD cover call ETF, whoever was making it either had nobody's intentions correctly aligned or a monkey put it together, because there's so many reasons not to trade a cover call ETF like QYLD, and in this video I want to cover about them. So let's just get right into it. And the very first reason why you should not trade a cover call ETF, let's say like QYLD, I think there's also one like XYLD, it's because they sell option contracts at the money, which is practically, literally, the worst possible strike price you could choose for a covered call. It just does not make any sense at all. You're most likely going to slightly, like ever so slightly, outperform the index it's on in a bear market, and you will definitely underperform the underlying stock in a bullish market. So anyhow, without me like explaining this to you, let me just go into my computer. I'm going to show you up an options chain, and we'll just go over this together. And what we're really going to be looking at is like things like max profit, income you're collecting, and also max risk, because yeah, that's an issue with cover calls. So you can see right here, I'm an option scout. This is my software. Let's just open up an options chain, and this is just a cover call calculator for, this is just a cover call calculator, all right? So let's just do what QYLD would do. So they would select like a month out. So they would select, looking like, well, I guess they do the end of the month, right? So I guess it would be this. And then they would sell this little thing right here. So a few key points I want you to pay attention to. Break-even point, max loss, and net credit. So here's the thing. If the goal, if someone's putting together this like whole thing, like the QYLD, I would assume the goal in mind is to outperform the underlying stock. Maybe that's why I'm saying it's a conspiracy theory. Like who would put this together in anyone's best interests whatsoever at all? Because it doesn't make any sense. If you're trying to beat the underlying stock, like I really don't know why you would do it. But maybe that's not the case. So anyhow, so this is your net credit, this is your max loss. So the maximum amount you can make here, and none of it is capital gains. Pretty much the max amount you can make has to do with the, I guess you get a little bit of capital gains, but you're practically getting no capital gains, you're just getting the credit. So there's other ways you can do this by just getting the credit and really reducing your max loss. Because now let's think about it. Okay, the best case scenario, you can make $1,200. All right, but if the stock shoots up to the moon, right, it just has to go to 380, which if we look right now, the 52-week high is 480, and the 52-week low is 360. So practically, they're going to buy this. Like this is what the fund will do. They'll buy the stock right now at essentially its 52-week low, and then they're going to go sell an at-the-money option. So the best case scenario, they make $1,200. But if it goes back up to its all-time high, like you're never going to perform. You're never going to be able to catch up. So, however, like, okay, that's whatever, right? So they have, but then the next thing is they have a pretty decent potential to lose a lot of money, because now if the stock goes down, like they're losing a lot of money there. And now it's like, okay, well, you're really limiting your upside potential, but if you're going to do that, you might as well just reduce your downside, but they're not reducing the downside at all. So no reduction in the downside, and then no anything at all. Now, here's a better thing you could actually do about this. Like if you really just want to go for the credit, look at this. You could just change this to be really, really far in the money, and it's not going to make any difference at all. Like let's say we do a 300 call. Okay, well, now look at this. So your net credit is here, which is actually not going to be your max profit. Your max profit's 132. So that is definitely less, but if we go, let's say 305, you're making a little more net credit or max profit, right? So let's get to 320. All right, so 320. So obviously, the S&P 500 is probably not going to get down to 320, but look at your break-even point. Your break-even point is 317. So it's like, oh, wait a second. I will be making this max profit as long as the S&P 500 stays above 320, right? Which now it's like, okay, you're getting credit, you're getting, that income that people want and strive for, but then you're absolutely pretty much reducing your downside dramatically, like really, really bad. And now this can be a situation where you could, I don't know if this would outperform. I would want to do a back test on this, but this is a better scenario because, okay, yeah, you're not making $1,200 in your max potential, but that's only if the stock goes down. But that's the thing. It's not, that's if the stock stays exactly the same, but stocks don't do that. They go up or down. So now with this, you can have a huge buffer. But anyhow, so that's that thing. Okay, so that was the first reason that it's at the money, which is literally just the worst case scenario. It's the worst thing you could do. Okay, the second thing I want to talk about is how you have no control. So this is an ETF. And the rules are already made. That the contracts are going to be sold on this date at this time, and nothing's going to change. And if you are a professional options trader, adjustments are super important. Getting in and out of a contract is super important. Rolling out a contract is super important. So when you don't have that ability to make any logical moves whatsoever, like, okay, well, all right, the stock really dipped a bunch right now. Maybe I scoop up an extra premium. Maybe I roll down. Maybe I adjust down my option so I get a little bit extra premium because obviously it's not going to expire or going to get exercised. Or maybe, the stock is like, maybe there's just a bullish sentiment going on and you can just tell that, okay, I probably should not be selling some covered calls right now. Or maybe I definitely should not be doing at the money. So that's just like an issue where, it's practically, it's not a robot doing this, but it's practically a robot doing this where it's like, we do these rules no matter what, which that just doesn't work. You need to use some type of logic and you need to understand what the market is going for sure. So that's the second reason. First reason, is selling at the money call options is literally the worst possible choice for cover calls. You're giving yourself all the potential max loss. You're not reducing it at all. You're getting some extra gains from the net credit, but you're getting none of the upside potential. The last thing I want to talk about is the expiration date. So it's a little weird. You're choosing a 30-day contract essentially, or like a 1-month contract, which is very odd. You don't really see many option traders talk about that. You see people either talk about doing weekly or 45 days out. That's really the two choices, and that has to do with theta. So 30 days is kind of an awkward situation where you're not going to be getting that much premium. Theta is there, but it's not the most ideal. So they would probably be better off doing, and also another thing as well is giving a 1-month expiration. Actually, okay, let's do this. Let's do at the money, right? So let's do what they talk about, and let's choose 370. So this is practically exactly at the money. So you have a 66%. Actually, this might be better to do this on a naked call. So yeah, anyhow, but it'd be better illustration there. But now let's say, let's just look at the ROI. Okay, look at the ROI, 37%. Now let's jump down to like a week from now, and let's do the same thing. Let's go 370. You can see the ROI jumps up a lot. And I think the probability jumped up 2%. Is that right? Actually, it might be exactly the same. Let's actually see the probability. Where is it? 1 month. And let's do 370. Let's see the difference in probability. Okay, 2% difference, which is, it's significant for sure. But here's the thing why this is super important. And let's go back. I don't even think this was the option I chose, but this is a little higher out. You're making much higher return on investment. And typically and again, this is not financial advice, but you will see that with weekly options. So again, this is why I'm saying whoever built this covered call ETF, where you have to pay an expense ratio to, is either a monkey, like literally they just had somebody pick something random. The people who decided it probably have literally no idea how to trade cover calls. Like maybe not professional traders, or they do know, and it's just like, I don't know. Maybe somebody. This is why I'm saying it could be conspiracy theory. Maybe somebody was like, let's not have this outperform the market because then a lot of people are going to start doing cover calls, or a lot of people, might not want to invest into the S&P, and maybe this could mess up the market. I don't know. It's just really weird because I think that majority of traders who are beginners into cover calls would realize this is not a smart thing to do. So you're choosing an expiration that is like doesn't even make that much sense to do. There's no logical reason to do a monthly cover call option all the time. At this point, you might as well do weekly, or maybe you could do 45 days out. I'm not sure. The first reason I talked about is that at the money is the worst case scenario. You're having the most max loss you can get, no upside, and you're getting a bit of credit that has some intrinsic value and a little bit of extrinsic value. It just doesn't make sense. You would rather have a higher percent of intrinsic value, or in my case scenario, I would say just go 100% intrinsic value. Like just go really, really deep in the money, because now your break even just cuts down a crazy amount where you're not going to have that downside. So that would actually be an interesting ETF, like a really more conservative covered call ETF, I would actually be curious to see if it would outperform, because I mean it definitely would in bear markets, right? Because it's got no downside. So you'll see just a little ticks up. It won't make a lot. I mean, if you do some of the math, you could still make like 10% or something like that. But yeah, that's my point. So with all this said, yeah, you could buy QYLD and you could get a monthly distribution. It doesn't outperform or underperform the S&P 500 that much. Like, it's not that dramatic. If you go on Google and you go type it in, you'll see it's a huge down. But you have to factor in that they're paying. I think the last 12 months was a 17% dividend yield, but the stock is down 27%. And then I think it has an annual yield about roughly 12%. But then the equity is down 30% over the last 5 years. So practically it loses 6%, but then makes 12, so it's a net like 6% gain, which then I think you'd be slightly better off just owning the equity. But anyhow, that's about it. That's why QYLD is practically a scam. But not a scam, but I think you know what I mean. It just doesn't make sense. Like I just don't know who would invest into this. So anyhow, see you in the next video.